We're live.
Hi everyone, my name is Nasser Hyat-Khan.
Mason
And today we're pitching Nuvei.
Yeah, so we're pitching Nuvei, which is a payment processing company out of Montreal, Canada. They provide services such as payment gateways, ACH payment processing services, and fraud and security protection. Nuvei did have its IPO in 2020, and due to the high growth of payment processing, there's a lot of room for companies to receive the unique services that they provide. Nuvei does focus on a lot of international customers and their markets, as they support over 586 payment methods, which includes over 120 currencies. Nuvei has a strategy called Land and Expand. We thought this was very interesting. They target companies with high growth potential, and they attempt to grow with them by offering one of their services and hopefully like retaining that customer so they can offer more of their services in the future. We found Nuvei by looking for companies with growing free cash flow, a strong and loyal customer base, and a lot of Googling as well.
A lot of Googling, mostly Googling, because I know I was asked that 3 times in detail. Thank you, Mason. As of yesterday's close, the price per share of Nuvei was $27.22, which brings my price to earnings valuation to $30.27, giving roughly 10.5% upside, and then my DCF to $36.25, with roughly 32% upside. Weighing those together the same, we get a new price target of $34.45 with 25.7% upside. Couple of questions that I wanted to address from D2L. A lot pertain to my G10 chart and FTX. So starting with the dip in August, Nuvei just missed earnings, and I think the market still had those post-IPO excitement where they were expecting more than Nuvei was able to supply, and I think that's the reason for the dip. In regard to FTX, there's not too much that I could find on that other than in an MDA write-up where management basically said that they hadn't done any meaningful business with FTX prior to their collapse. And in my opinion, I think that there was some discussion about doing business, which either fell through or Nuvei may have realized that there were some problems with their business model. And then I think, was it 3 or 4 people asked me why I did a 7-year DCF? Something I was taught in primary school was ask 3 before me. In this case, read 3 before me. Long story short, Nuvei had its IPO in 2020. We haven't seen a long history of cash flows like other companies I and my classmates have pitched in the past, and I think we need some more stability before we properly see growth in DCF outputs. And then finally, my ROIC is expected to exceed my WACC in 2Q 23. Without further ado, I leave that to open the floor to questions. Oh, Mr. Walker, no.
Oh, Mr. Walker, actually first.
I have to beat you up.
Go for it. That's the last one. Hit me with it.
Okay. Margin assumptions for 23 to 22 is 27, net margin 27 versus 14%. First of all, how do you justify it?
Well, I think it has to do with client acquisition and then the net revenue retention rate. So it's my understanding that, and if I'm answering this incorrectly, just hit me with it, but it's my understanding that Nuvei waits a year after onboarding clients in order to count them down for growing revenues.
So then why didn't you see that in 22 versus 21?
Because 22 is almost over, and I think consensus is pretty much on the margin. Pardon?
But if you just look at the model and you look at your operating profit, you're almost implying 100% incremental margin. I'm a big favorite of incremental margins. Looking at my numbers, so yeah. If your revenues are going up 250 million, you basically have a $200 million increase in profitability, which is pretty close to 2/3 of incremental margin coming down. Very, very unlikely to have such a big increase in margins. So, I mean, I agree that maybe a growing company, but the margin assumptions you're making are really quite substantial, especially when you're looking at your EPS numbers. Your 245 is about 90. I assume that there's a huge increase in the number of shares outstanding, but that wouldn't be the case because they came public in 2020,
right?
Not 21. So that should be apples to apples in common shares, so if you've got your income going up very substantial. But it doesn't show in the EPS number either. So I question you on your margins and your calculations on earnings per share.
Well, I'm not gonna say $1 million, but a million share buyback is gonna, or, excuse me, an addition of 1 million shares outstanding is gonna change my EPS that much. But I think given the rate that they're acquiring clients now, and the partnerships that they hold with larger companies like Visa and Alipay, are gonna accelerate revenues and increase margins for that regard.
Let's take a look at that, then your comp margins, are comparable companies having net margins that high?
No, but they're piggybacking off of their systems. So they're taking a portion of, so like, let's say, Dr. Wall and I discussed this, where Nuvei is getting into Visa's system and has a higher transaction per second funnel because they're piggybacking off of the system. So right now they're doing 88 TPS, and I know this is off topic, but they're doing their 88 TPS, but they have the potential to do more. And I think with the partnerships that they do have, they will do more in the coming years.
Okay, I'm just gonna make a comment that I think your expectations of margins are really
High,
quite,
yeah.
Excessive, frankly. Leave it there.
Thanks, Bill. Dave, did you have a question? You had your hand up earlier.
No, not
Great.
yesterday.
Nice work, Nasser. Could you just explain a little bit what happens when the company does win these clients like Sheen and Epic Games? So what do the contracts look like? How long usually are these clients? And then what do the fees look like?
Fees were undisclosed. I think with smaller businesses, there's a mild termination fee, but with these larger companies, they didn't disclose them to my knowledge. And then the process, contracts start off with at least, it's a minimum of a year, depending on the size of the company.
So then what is turnover? What happens if, not just these clients, but do they share clients that they've lost?
What do you mean, share clients that they've lost?
If a client decides to go to another payment service, do they disclose that?
Yeah, I mean, it'll come out in the news. But turnover, to answer your first bit, turnover is really low, and that's why net revenue retention is so high.
Okay. Thank you.
Any questions?
No, Dr. Wall, please.
Dr. Wall had a question.
God, no.
Who's that? I don't
Computer
think.
too.
First one's for the mentee, I think.
Oh, thank God.
By the way, I'm just an avatar today. I represent OpenAI. I don't actually have any questions of my own. So as an avatar, my master has asked me to ask you, what revenue segments does Nuvei operate in? What are the main revenue segment ones?
So they have one reportable segment, and they contain their international sales as well as their United States sales in there. Mostly it's international. United States is the second highest. It's mostly based off their e-commerce and mobile sales. Yeah.
If you
Good
could
enough
get,
for me.
if you could get greater disclosure, if you went to the company and said, ideally I'd like to see revenue broken down by A and B and C, what would that look like?
I think it's how they break it down is pretty solid. I would probably say maybe more point of sale, kind of more specific with that, because they did disclose that, but not very in depth. Yeah, it's kind of.
Which is when you said they only had one
Yeah.
segment, I thought you were saying they just needed one. I thought it was your model. I get them all mixed up, but
Can I
I
help
thought you had
them a little bit?
98% of revenue in one line item,
Can I
right?
help them a little bit?
Yeah, sure.
So technically, it's two revenue segments. The second one being called Other in their 10K, and the first one is merchant transactions and processing services, and the second one, Other, is point of sale devices, and that accounts for 1% of revenue.
Right, so they really just have one line,
Yeah.
they don't break it out. That's
Correct.
sometimes, if you guys ever see a company that doesn't break out revenue, you gotta kind of scratch your head and go, why? And then say, well, could I learn something more if I could break it out even further? That's all I'm trying to say. Or is it one homogeneous? Are you selling copper, some one commodity everywhere globally?
I was just gonna say on top of that, in one small article on their website, they broke down their revenue into their verticals, so every like industry that they're in.
Beautiful, that's the kind of thing would be really
Um,
nice, wouldn't it?
yeah.
Okay, cool, good. Dr. Wall, that's what, another question, Mr. Avatar.
Yeah, Brad, we generated 3 for each in a minute.
Oh, jeez.
So next one would be, how has the addition of Nuvei for platforms impacted revenue estimates in your model for 2023 and 2024?
I guess that would add on to
Can
Mr.
you quantify
Walker's
that?
boost in margins.
Can you quantify what you did to model that specific product, Nuvei for platforms?
No, I couldn't.
Next one, how does Nuvei's net revenue retention rate compare to the industry average? Do you know what the industry average is? Do
They
you know what
do.
theirs is?
For software as service companies, it's 35%. For, I want to say with fintech companies, it's 37%, and then banking is 75%.
Nope. And so what's Nuvei's in there? You got the
As of
industry.
21, it was 146%, and I'm projecting
You have a retention rate higher than 100%.
that's what they posted for the actuals and on their website, and then I'm assuming the client turnover is low, so.
Wow. Really low when you have it.
Yeah.
I mean, you're able to keep more customers than you have. That's
So
amazing.
literally, like, I think what you're trying to tell me is that your customers are having children and are instantly becoming new customers. Some sort of.
I see nothing
Not
wrong
you.
with that.
Well, I mean, mathematically, you understand what's
Right,
wrong with
yeah.
what you just. Like,
do,
I
it's
get you
weird.
got your sources of the company, not a problem, but do you understand what's wrong with what they're saying?
Absolutely,
I
yeah.
can't.
Yeah, when a
Actually
company
happen.
gives you a number that you're like, this doesn't make sense, you want to probably dig into it, and maybe you did, but companies do this. They'll give you numbers that just they don't make sense, and you gotta.
Yeah.
And they're trying to promote their brand, obviously, but the rest of the world, we need to repurpose so we can actually understand what it means.
And I'm assuming Dr. Valentine's gonna ask this because I'm done representing. I think in some ways you got the benefit. For those that care about such things, maybe for full disclosure, I'll tell you the settings I use to generate the questions. Right, so I'm done, don't worry. But I am gonna wanna know what the special sauce is of this pitch, right? By now, we should have that down.
Okay.
What you guys did that's unique, different, super cool, makes this valuable, what we just heard. That's gonna be my own kind of human throw-in. But in case anyone's playing along, I used a 0.8 setting for creativity, and I used a max word length of 964 for those questions.
I think
I think that sounded like a foreign language to
So
most of us.
So what was your special
Each one of them.
effort beyond just reading company documents, websites, that kind of thing?
Well, I tried reaching out to the company to get a proper list of their clients, to which they refused and said that was not allowed to be disclosed to me for reasons of the company. In addition, I made my own valuation metric. How accurate it is, I don't know. I haven't tested it out with other companies just yet. So that would be price to transactions per share. That brought me roughly around the same upside as my price to earnings because it was factored in the same way. So
Great. Any questions? Hey,
no way.
Hi, Nasser, great job. So with the company like IPOing in 2020 and then looks like you're just projecting out, sorry, I just lost the number here. 7-year DCF. So my question is just why pitch as a buy now and not further down the road? Do you think there's value to be captured now?
Because I'm retiring.
No. That makes sense, yes.
I think too.
Versus other companies that you could have pitched in the same space
Yeah,
now
I
that are
think
further
too.
along.
I think too that they're sort of rounding the bottom where the market is not. I don't want to say just beginning to get a sense of the growth in the company, but I think more so along the lines of like consensus is starting to price it in, and that's why I think now is a good time to buy, because then they're just going to go up from here, and it's like, why, if they're at the bottom, why don't we capture them there? At least in my opinion. Now, I could be completely wrong, but I don't think I am. So.
okay.
Alex.
Alex.
Good job, Nasser.
Okay, you guys get done, let's get started. We have 6 pitches to go through today, so we're gonna
be here till 4.
Yeah,
I will
I'm
move this
fine.
quick. So I'm Mastalish, senior in the AIM program. This is my mentee.
I'm Melissa McMahon. I'm a junior in the AIM program, and for this pitch, I covered moats, purchase by forces, and revenue drivers, as well as stage of growth for the company.
She also was instrumental in a couple areas of research and writing, so I thank her for her efforts and her help in our pitch of Churchill Downs. I guess where to start is kind of this. Actually, I'll
So why didn't you just because you laughed almost like you. I was bringing up from a presentation standpoint. You almost like laughed
That
like
was like a pop star laugh.
You know what? You know why I laughed?
Well, that's
They
why
laughed.
That's what I did during my satellite.
Sorry.
So I
It was
got
like a
a
pop star
little
laugh,
distracted
like
by
in the
my.
song.
I got a little distracted by my audience. I apologize.
That's okay. Well, I just didn't want the audience to know that because it sounded like you didn't really care about your pitch.
No, I
And I know you put a lot of effort in
That's
it.
exactly what I thought.
Mr. Mellis doesn't put any effort or care into his pitches.
All right.
Keep going.
Anyway,
You're doing great.
I guess like a common, I guess a common D2L question or one question I thought of note was a question that Basil asked. He asked about, because my company carries a decent amount of debt, about $4 billion worth, and he asked about like the free cash flow or the cash flow coverage. So essentially, how long would it take for my company to pay back its debt if they just allocated all cash flow? They just said, we're just gonna do nothing else. And if I can find that. And I calculated that out to be roughly about on a sliding scale of about 4 to 5 years. As cash flow increases, that decreases.
And why does that have any relevance to equity holders?
I think that has relevancy to us as a program, looking from a fundamental standpoint, understanding that they have a lot of debt. If the market were to become adverse, that is something to consider.
Okay, well, that's important to equity holders. I didn't realize they had a lot of debt. So what is their debt to total capital or debt to equity?
Their debt to equity is currently about 9.66 or 9.6 trailing.
Okay. Okay.
Debt to equity percent's about 58%. So.
Okay.
Yeah, Alex, great job. In terms of them paying off this debt going forward, do you have any, I guess, assumptions or any signs from the company that they're going to be taking on any new projects that would require them to take on more debt before they pay this debt off?
Yeah, I don't have any signs that they're going to take out more debt to finance any of the projects. I do know they have a pretty long laundry list of capital expenditure projects, mergers, those sorts of things that they've guided towards, that they're kind of using these the additional debt that they've raised to kind of finance and pay for these things going forward. And all the projects to me, whether they're ranging from HRM expansion to expansion of the Kentucky Churchill Downs itself, the racetrack and building up that fan experience, to casino expansion, in my mind, it's all pretty justifiable spending and quite honestly necessary to not only justify the growth that I believe that I'm forecasting, but also think in this industry from a pricing standpoint, like the only way for this company, in my mind, to continue to grow is what they're doing, to continue to invest back into the business and try to expand their customer base that way.
Okay. Sorry, quick follow-up. I don't know if you found any like direct peers, but how does like their debt to equity, for example, compare to those of their peers?
I didn't really find a direct peer. It's really tough just given, anytime you're looking at peers, it's, obviously a tricky endeavor, but I would say for them, they have the intangible asset aspect of it, that's very valuable. That kind of separates itself from a Caesars or a DraftKings of sorts. It kind of separates them into a market that I can't really justify a comp.
If you, would it be possible to, not saying right now, but if you'd had more time, would it be possible to say, well, they're in these 2 or 3 different segments, and they carve them out, and almost like Disney, where you say, okay, I'm going to compare parks to Six Flags, I'm going to compare ESPN to
Broadcasting provider, right?
provider.
Yeah.
So could you have done something like that? Did they give you the financials broken out enough where you could separate?
Yeah. I mean, they do give. That was one of my, I would say, one of the better parts of evaluating this company was they do guide pretty well, or not guide, but they do break out their segments very well.
Okay.
So
good. Well, so that's something to keep in mind. If you have the problem where you're like, I can't find a perfect comp to this company because they do more than one thing, then potentially break it up into different companies. Way in the back end, Basil.
So I was actually trying to, for my first pitch, I was actually going to do Churchill Downs. And what I realized that the reason why they had so much debt is because they were acquiring online gambling and online gaming sites. So I guess the question I have for you is that the census really doesn't write about that. How come you decided to focus on the live gambling aspect, and how come you didn't decide to focus on their acquisitions for their online segments for research? Like,
yeah,
would
so
that have helped you?
I'm going to disagree with you on that just like a little bit. They're divesting out of B2C gambling, so like business to consumer. And they're shifting more towards, in the online space, more towards B2B.
Right.
So that's where kind of the news of the partnerships with FanDuel and DraftKings, that's where that sort of comes in. We did look into it. That was something that I thought could be a possible critical factor, or just something of note to look into. Was in contact with a reporter of this website who looks into like legal sports and that sort of area, and he specifically covers sports gambling. And we kind of had a lengthy conversation about what he sees of the 2 partnerships and kind of where they're going in that kind of niche, the online gaming. And he sees growth opportunities there, but and I tend to agree with him, and obviously reflected that in my forecasting. But as for the new partnerships, he said it's too early to tell, and I do agree on that. Management has not disclosed anything at all about the details of FanDuel or DraftKings transactions in terms of what the payout structure is on each wager, what the upfront cost for the technology is going to be. Analysts in the last earnings call asked 6 questions about that. They only asked 2 about HRMs, but that justified going a little more in depth into HRMs.
Okay, so then I would ask you then, if you disagree with it, then why do you think management took on so much debt to acquire these types of online gambling? Wouldn't that just
they took on, and from my understanding, they took on all this debt to finance their capital expenditure projects and these expansions, not into gaming, like the online gaming, but into the live gaming, which the HRMs of the world, the Kentucky Derby, the Churchill Downs track, that sort of thing.
Okay, so then I guess, did you do any other metrics such as casino to chairs to the actual square footage that they would have?
No, I didn't really go that in depth, looking at the economic. From what I looked at from an industry output, I didn't seem like it was justified to go that deep into
but they're
the
spending so much money on CapEx for their live gaming. So how come you wouldn't forecast out the growth?
I did. I just didn't go that granular into each casino per chair per person. If that makes sense.
Well, okay, so hold on. I think the basic question you're asking is, why are they spending so much capital? I think what you're saying is that they're spending this capital, they want to spend this capital, so they've got to have a boatload of debt. I don't know if that's true, but if that is true, I think what Basil's trying to figure out is why are they spending all this capital?
Yeah, and I told them.
Okay.
So, I don't want to rehash it again.
Okay. So next question, August.
2 questions, if I could.
You have $1 billion of floating rate debt. What is a 1% change to your interest expense?
Yeah, about 24 million a quarter.
Okay, is that material?
I would say no.
Okay. Second question, you talked about this a little bit in your D2L, but EPS was revised a couple days ago. What was the story behind that?
Yeah,
Rise up or down?
down on the G10. And that kind of came because of a new sell-side analyst coming in and initiating coverage. Have not gotten access to that report due to Refinitiv kind of having that time lag that they do. I think by tomorrow I should have access to it. I know what their price target was because I did like I saw that the G10 chart, right, that earnings estimates have been revised down. I obviously like panicked because I'm like, oh my God, what happened? Like, did I miss something? Just kind of did a quick Google search on news, saw that a JP Morgan analyst had just initiated coverage, price target of $243. That's all I could grab out of that, and we'll see the report when
In the future, if you guys need something like JP Morgan or any of these other things, if it's a high-profile stock that you're about ready to do, reach out to me or Dr. Waller both, and we generally will find people that can get you the report. Like we have a really well-known alumni who came here 2 years ago. She's there now in the research department. Not saying anything wrong, but I'm just saying we can get that stuff if it's important, which it sounds like may have been. Sorry, did someone else have their hand up here in front? Okay, so go ahead, Harvey.
Yeah, I know US gambling laws are very segmented by state. Which states does your company operate in, and are they planning on expanding to other states, and how hard is it going to be for them?
Yeah, so they currently operate in 4 states. In particular for HRMs, kind of my critical factor, what I focus on. They operate in 3, and they really target, to my understanding, they really target areas that, or states that have laws against slot machines, essentially making it illegal for anybody to gamble on games of non-skill. And that's where HRMs kind of finds its niche. It's technically pari-mutuel wagering, so a game of skill, but also provides like a slot-like experience. So you get, the ease of play with all the lights and the sounds that obviously people are usually attracted to in slot machines.
Great, thank you.
Question over here, Joe.
So is that easy to replicate and for someone to just go and copy and do the same thing?
It's actually not. And that's like kind of going back to what I was talking with Aiden, or kind of mentioned. They're intangible assets in terms of holding the rights to the Kentucky Derby, and like the history of the Kentucky Derby allows them to have these simulations of horse races. That's essentially what an HRM is. It's like a playback of matching different historical horses against each other. Because they have the rights to that and they have the depth of that allows them to have a considerable edge, along with their locations. Being primarily focused in Kentucky, horse racing is huge there, obviously. It allows them to kind of have I would say a moat, in my opinion, on the market.
Hey, once again, great job. Obviously, like horse racing is big in Kentucky, like you said, but it might not be as big here as it might be in other parts of the world. Do you find any like potential international peers or competitors that may or may not enter the U.S. space or compete with Churchill Downs in the future?
I didn't see any. It is bigger in England, in particular. The UK horse racing is pretty, both like I'm gonna butcher what it's called, the sport where they jump, like the horses jump, and then regular horse racing.
Hurdles?
We just call it jumping.
Okay. Jumping. Between jumping and regular horse racing, it's pretty big over there. I don't see any reason for them to come across the pond per se and kind of cannibalize on what Churchill Downs is doing in Kentucky.
Well, we're on this topic of kind of moats and so forth. Would you like to share what you saw, what you conclude the moats are?
Yeah, sure. So I could elaborate on that. I think that their ability to pivot is really indicative of their network effect as an economic moat. And like going back to the conversation about their transfer to the B2B space rather than the B2C space, that was kind of because in Q4 of 2021, they realized that they had generated like negative 1.6 million in adjusted gross revenue. So that was kind of their sign that they had to leave the online sports betting space. And I think like their ability to pivot like quickly within like the next quarter, the next like 2 quarters, showed that like they can really utilize their network and like have like an expansion of customers. Like there's a good outlook for their expansion of customers in the B2C, the B2B space rather than the B2C space, using that network effect.
Other questions? So, great.
So if your downside scenario is like higher than what the price is right now, like, are you just saying like that there's essentially like no risk? Like the worst that could happen would be that we get $20 off of it?
No, I mean,
Like, why isn't it that price right now then?
I mean, candidly, any company, the worst that could happen is it goes bankrupt. I don't see a bankruptcy risk, therefore I kind of assumed a realistic bear case to kind of give us an outlook. I can certainly get back to you on like a doomsday scenario in which, like, I don't know, comes out that the CEO is doing something illegal or something. I'm not going to toss out because we're on live stream, but.
That's a good point Grace makes. That I mean, if your downside, I didn't notice that. So your downside's 20% upside.
Yeah, I
So
think she said $20.
It's $249 and the stock price currently is $220. Like
$20. It's about
10%.
10%. Yeah. So the 10% upside to your downside scenario. I think just as a general rule, you want to make sure that your downside scenario is below where the stock is right now, because presumably, you know, all the buyers and sellers of the stock right now already have some expectations about it, and that's kind of, I guess, that's all the voting going on by the buyers and sellers. I think it's, unless there's something that's, I just can't think of a scenario where your downside scenario would be above where the stock is right now.
Can I counter that for like a learning
Yeah,
experience of my understanding?
Yep.
Isn't what moves the stock going to, actually, no, that proves the point. Never mind.
What I'll throw this out. I mean,
no,
you're talking about a recession, right? At least most people think we're going into a recession over the next year. And you would think that gambling is not necessarily like an absolute need, right? So it's probably a consumer discretionary, right? So I would just be careful about saying, under that scenario, that my stock has no downside.
It's fair. I can get back to you on a more bearish outlook.
That's okay. I just think it's the last day of semester. You do more work. Dr. Walsh.
Since I mean, last I knew, alcohol and gambling actually usually went up in bad environments, but I don't know if that's still true.
Oh, do they? Okay, good.
Yeah.
I'd be curious to know if that's
Or like if like something happened with their debt.
Yeah.
Or if it
Fair.
just stayed
It's a fair
like
point.
the exact same
Fair.
as it did right now.
But yeah, no, it's still, the point is there should be some downside.
Yeah.
All right, so I like the first question because it's a two-parter and it actually hits the two of you, so it's kind of nice. The first part of the two, I'll break it, says, Melissa, which of the modes is most exposed to competitive pressures?
Okay, good question. Thank you for asking.
You're welcome.
Competitive pressures, let's see.
So while she's looking for that, Alex, the follow-up is going to be, how did you build that into your downside case in your model, which actually piggybacks right off the discussion we're having.
Yeah, I just.
You don't even know which one we're going with yet.
Well, I'm going to tell you how I calculate my downside. All right, Melissa.
Well, we know that intangible assets is definitely not very exposed to competitive pressures because
So
they're,
which one is the most exposed is the question, in your opinion?
I might have to get back to you on that just because they operate in such a.
Sorry, can I just step in here for a second? So the thing I think that might be kind of confusing, than AI is, maybe it doesn't, is that if a company doesn't have a moat, you really aren't exposed to it, right? So if they don't have a network effect or something, then it
Let's
was
reframe. Of their segment lines, revenue segment lines, which one's most exposed?
Okay, I'd say definitely like their hotel, like an entertainment segment
Great.
is like exposed.
So Alex, how did you
The casino
account
segment.
for the revenue, the hotel segment of their operation
Yeah, so
experiencing troubles.
Yeah, that goes with casino, it's entertainment.
Fine.
I just kept a decreasing revenue in terms of like my growth for the existing casinos inside of the company. And then obviously there is growth in the segment due to what you would call inorganic growth with additions.
So you're pre-assuming they're gonna keep buying their way up, and that's what's gonna drive the stock.
I'm not pre-assuming they're gonna buy their way up.
Inorganic growth implies acquisitions.
Right, they've already done the acquisitions. So
Okay,
I'm
so you're
forecasting
forecasting that that onboarding effect will be profitable.
Yes.
What if it's not? Haven't we already seen evidence of that in COVID? I assume those divisions probably weren't profitable during different parts of COVID.
Was profitable since a major reopening of the country itself. I guess I can get back to you on a downside scenario.
No worries. And what's the next one here? I won't go down all three. What's the best one? Okay, I kind of like this one. Did you model out the estimated value? Did you measure out the cash flow value, present value of your most recent capital expenditure? And when do you expect it to be complete? The big one. So when do you expect it to be completed? And did you put a DCF kind of on that little piece to see how much of your evaluation is tied to the success of this piece?
I did not. I can tell you how much it was, when it's done, 400 million, estimating it being done in Q1 2024. Didn't do a present value or spend cash flow on that.
For past projects, have they been able to complete them on the timeline they projected, or has there been?
There's been a little bit of a lag here, so I added on a little 5% premium onto the CapEx spend just to of that they've forecasted to adequately adjust for the way that they've kind of been completing projects. Projects have been coming in a little more pricey than expected, and also slightly late by a month or two, which is honestly to be expected in this current construction climate.
That setting went up to 0.9 and it's kept the same 980 grid setting for those playing at home. So I took up the creativity slightly on your questions.
Perfect. Great, thank you.
Good job, guys. Yeah. I think it's you. Oh, we have Anwar. All right, good question. Whoa.
My mentee booth all the way in the back.
Do it again.
Yeah, so I was like, wow, that is a doctor's wall. Like, I was like, that is something I actually think.
Okay, we're gonna keep moving on, folks.
Show off.
I think we are.
Yeah. All right, my name is Anwar, and along with my mentee, Sarah and Rich.
Folks, keep moving on. Thanks.
Yeah, so along with my mentee, Sarah and Rich, we're pitching SPS Commerce as a sell. SPS Commerce is essentially a supply chain-based software company which enables retailers, distributors, manufacturers to connect to a centralized network and share data and information in real time, creating some efficiencies for their operations. I looked into a lot of different avenues to find ways to see what consensus might be missing. I reached out to the CEO of the company, got a lot of good insights into his strategy and what he thinks the industry and where it's moving going forward. I also reached out to the Chief Technology Officer of SC Johnson and learned a little bit more about the technology and uncovered a few things about where he thinks spending for supply chain software is going to go.
Sorry to interrupt you, but just so we're clear, because I asked him about this, you actually had conversations with the CEO and this Chief Information Officer, right?
The Chief Technology Officer.
Of these two companies. So it's not like, because sometimes students say, I contacted, okay, but nobody got back to you. Or they sent you a one-line email. You actually had meaningful, like a 30-minute conversation with them, right?
Yeah, I talked to, well, actually the Chief Technology Officer, I talked to him for like an hour and a half. So the CEO, we only talked for about 45 minutes.
Okay, good point. So sorry, I just want to make sure we have context in what you're saying. Okay.
Yeah. Yeah, so found a couple compelling ways to be different, especially when it comes to like ERP systems. The chief technology officer told me that SAP is actually ending their support for one of their legacy ERP systems. And that's typically a good opportunity for SPS Commerce to go in and acquire some new customers. So I forecasted them being able to penetrate that market a little more. And this is an area where I didn't see anything from Consensus, and they don't really know that this is kind of happening. It's an interesting point. But ultimately, I think it's a really good company, but I think a lot of growth is already priced in. And when I modeled it out, I think it's a little bit disconnected from its fundamentals. So that's kind of why I'm coming in with the sell. So I guess I'll open it up to a question.
So can you just, for everyone here in the room, tell us what is your 2024 earnings per share and what's consensus?
Yeah, I have that. So I'm above consensus on my.
I'm just trying to figure out how much. I mean, I assume you would be because you're fundamentally bullish towards the company.
Yeah. So NTM +1, I'm about like 18 or so % above consensus. 18%. So it's like quite a bit.
So
yeah.
I just want to illustrate everybody, it's kind of a learnable moment here, coachable moment, that you can have situations like this where you think fundamentally you're much more bullish than the street. And think about, remember we talked about what makes up a price target? It's your financial forecast times some kind of multiple. But I think what we're saying here, Anwar is saying, I have even a higher financial forecast, but I'm going to take the multiple down quite a bit. And because, and for some of the reasons you already mentioned, and if you guys want to dig deeper, that's good.
Yeah,
for Q&A.
And with Dr. Or Professor Walker's feedback too, like I reached out to John Malooly, just a few like email conversations with him. He used to own the stock in his own fund, and that's definitely something that he's also concerned about, is just a really high multiple. And so it's no longer a part of his fund as well.
Okay. Questions? Hey.
Hey, Anwar, great job. Maybe this write-up's outdated. It's the one that Jess sent out, but in valuation only talks about a 10-year DCF. Did you do multiple like?
I did a bull bear case. You got to scroll down.
But in terms of PE, I think David's asking, did you do another valuation method? You're saying?
Oh no, there's no other. So I didn't use the next 12 months like PE value.
And I think the reason why, yeah, go ahead.
So this company's not at like a maturity stage. Like the PE is, it changes quite a bit with the growth expectations. And when I talked to Dr. Valentine too, we kind of talked about how that method really works the best when a company reaches like its maturity and it's growing at a more stable rate. So that's why I kind of decided not to include this valuation method, because this is a growth company. It's growing a lot faster.
And that's right. I want to maybe be even clearer on that. So what's the earnings for 2022? Earnings per share?
EPS for 2022.
The point is that the difference between 22 and like 25 was ginormous.
Yeah, it's a lot.
It's like the companies with doubling or tripling their earnings in a relatively short period of time. So then you got to ask yourself, well, what year do I put the PE on? Do I put it on current year when it's going to double or triple in the next 3 or 4 years? That's unrealistic. Or do I go put a multiple on the future?
Maybe not just PE, but like any other multiple in general.
Yeah, I mean, you could look at something like sales.
Yeah, I looked at that, and this company was trading expensive across all the different valuation metrics relative to their peers, and I looked at it, so I did decide not to include it at all.
That's a good point. That would be probably helpful to see. But yeah, August.
If you assume a 3.5 market premium, it's actually 5.5. Okay, never mind. How did you calculate your beta though?
So yeah, interesting thing about the beta. So the 5-year monthly beta was like 0.7, and then like the 52-week monthly beta was like 1.1. So I looked at a lot of sell side reports and tried to see what beta they were using, and if they were all using 1. So I decided just to keep it like apples and apples with them, just to go with 1.
Mr. Walker.
Did you do any precedent transactions, valuation work there? It seems like that whenever I looked at this company, I owned it when I was a portfolio manager. One of the things that was always attracted to me was the fact that they could either be bought out by Oracle, who's been buying applications, or maybe even SAP, for instance, could actually buy them. And I'm just curious if you've done any valuation work on the basis of that.
Yeah, no, I actually did not consider any buyout scenario. I could definitely go back and see like what multiples some SaaS companies have been trading at, and see if I can build it into the valuation, but that's not an angle that I took when I was valuing the company. Alex.
Yeah, great job, Anwar. You in your appendix have this great survey, really like it on 3PL. It's by NTT Data, Penske, talking about shippers and distributors and kind of the trend of what they're like looking at focusing on. Do you kind of share that same, or how easily can SPSC like shift, like in terms of like accommodating for those needs? Because it seems like they're kind of positioned well now, but like maybe in a later date they might not be as well positioned. Like what kind of strategies, especially talking to the CEO, does he have going long term on kind of product lines and kind of shifting software?
So I would say they are well positioned right now for the future of where I think like the 3PL segment is going, in with like how they would integrate into this software, because their platform is pretty versatile. Like you can use a lot of API based applications to integrate directly with them. So there's not a lot of like technology holding them back from being able to capture that market share. And with 3PLs are now taking a lot of the fulfillment part of like e-commerce, like picking, packing, shipping. A lot of companies are now relying on them. So I think they're pretty well positioned right now to like account for a lot of changes that you might see even in the next few years.
Chris.
I know you mentioned like SAP, but like what does the market distribution look like for other companies? And do you see like them taking over like any more market share like you were kind of talking about?
So this company doesn't compete with SAP. So I might not have made it as clear in the write-up as I should, but so SAP is an ERP software, and a lot of companies rely on that. And this company essentially has a network that can integrate into those ERP systems. And then usually for the CEO kind of talked about how like whenever the company finds other businesses that are in the process of upgrading these systems, that's usually a good customer acquisition opportunity for them. And one thing that we found was like SAP is actually ending their support for one of their like core products in 2027. So there's going to be a lot of companies that are going to have to invest in upgrading these systems, and that's going to create this new demand for more like integratable software, and
Gotcha.
that gives them more of an opportunity to acquire customers.
Okay, so like maybe down the line when that is like closer to happening, this would be a good investment.
Well, I mean, I think a lot of this company is still trading like pretty expensive. Like they're pricing in a lot. So I think a lot of this company turning into a buy would have to do with the price moving to be a little more near fundamentals, I would say. But yeah, I definitely think consensus is going to catch on to this pretty soon, because this is a pretty compelling opportunity for them to acquire customers. And they do have a sales force dedicated to SAP clients as well. So I think it'll become clear pretty soon and be reflected. So.
Okay. Thank you.
I'm just gonna jump in here and ask the Mentisa question. So what would you say is its most dominant mode?
I think personally, you wanted to.
And that's what my part was, but so I guess the most dominant mode would be their network effect. They just have a very large retail network, a lot of different like prominent suppliers, and they're able to kind of take their old customers and network them with new customers. They also already have a very large like client base formed. And I actually related that back to like their high switching costs, just because like all those customers have acquired, like they don't want to switch to different companies because they had such good networking opportunities in this like network that SPSC forms for them. And like trading partners can just trade like information electronically pretty efficiently.
Great. And then I think we're going to get first forces.
Yes.
So what would you say is like one or two of the really standout forces that either helps them or hurts their industry?
I think what really helps them is their buying power. They have a lot of what's the word I'm looking for? They have a lot of repeat business, and a lot of that comes from them making new products and services, and with that, they have customer retention, and that's good for them because if they were to, become complacent on future products, it incentivizes customers to go to like a different firm or something, as opposed to where they're continuously making new products and softwares. It retains customers and helps helps their business line.
Quick question, Dr. Wall.
Just once. Given that ERP system upgrades are likely to diminish given the recession, but have been a crucial customer acquisition catalyst historically, how is this reflected in your estimates and model?
Can you repeat the question?
Given that ERP system upgrades are likely to diminish given the recession, but have been a crucial customer acquisition catalyst historically, how is this reflected in your estimates and model?
Yeah, so I think the number that I took to model into how many upgrades I think is going to happen was pretty conservative in my base case, and then I have different scenarios for
Did that number go up or down from last year?
So it was hard to tell because they didn't really say like, oh, we acquired.
Did your model increase or decrease the number of
Oh, it keeps it the same. So I'm assuming like 1,700 like.
So AI is assuming that number is going to drop.
Mm-hmm.
Did you do that in?
I did the bear case assumes that the number drops and I get even more downside. So it really didn't change the call at all. So I did like kind of look at.
Good job, Anwar.
You got to go. So I guess four, yeah.
I like no. Like no, but like it's a good team.
So wait a second.
Oh, Harvey. Always put your biotech. Always put your biotech.
Okay, we'll keep going, folks.
All right. Yeah, we'll get started. For those I haven't met, my name is August, a senior, obviously. King of Cell on.
Sorry, I know it's Friday, it's the last day of the semester, but we want to make sure you do this, so.
Yeah. But you can sell on PROG Holdings.
I'm Zach Eugene, I'm a junior.
I'm Sam Kempton, I'm also a junior.
Yeah, so it wasn't really a common question on D2L that I could address, so I'll just talk about my screening process. I honestly spent like a month trying to find like a good buy. Like I obviously tried to screen for a buy, but I just couldn't really find anything compelling in the financial services industry. So I ended up using Valentine's Screener for the lowest coefficient of variance among sell-side EPS estimates. And I just picked the lowest one to see if I could find anything where I could have a differentiation. And that was Progressive Leasing. Their coefficient of variance was like 0.04, which means like of all the sell-side estimates, like there was little to no variance among the mean for like what the consensus forecast was for it. So yeah, that was kind of my process. And I think I'll just open up for questions.
So along those lines, let's follow up. So why do you think the analysts were so close together? And I guess I'll throw specifically in my mind, I'm thinking it typically goes in a few buckets. One, they're just lemmings and sheep to slaughter. They don't really think for themselves, which does happen sometimes, too often. Management guidance is guiding them there, and guidance is usually pretty accurate, or is there something else?
Yeah, I think guidance is a little bit accurate. I think it's also kind of difficult to forecast because it's like a lot of it's economically driven. Like the company does well when unemployment rises and when the economy just does poorly. So kind of forecasting out the health of the economy and stuff like that is really difficult. So I think it's just tough to forecast in general. But
does the company provide guidance?
Yeah, 1 year out. Yeah.
Okay, so they probably are. Yes, it's typically a low variance like that. It's because management providing guidance. Okay. Good. Let's open up the floor.
August, great job as usual. Can you just talk a little bit about what consensus has to say about this stock? And if you read sell-side reports, what those authors had to say about if they agreed with you or whatnot. Yeah. So they're saying they're looking like really short term. There's not like a huge catalyst for a jump or a drop in earnings. It's kind of hard to find like a really specific call on it when I was reading sell-side, but a lot of the talk is sort of around the fourth quarter of this year because it's the holiday season, and there's just a lot of speculation on like if consumers are going to spend more than they have a year before, if they're willing to extend credit. So yeah, a lot of it's very abstract. Like it's not super specific, is what I'm trying to say, but yeah, it's a lot of it's like the fourth quarter this year.
Okay. And real quick follow-up.
in terms of it being market cap under $1 billion, right? 997 million.
Right.
Do you think the stock might be at a level where it's too small for analysts that are covering the stock or for the market in general to be maybe ignoring some of these clearly like unethical things that you found with this company, and just looks directly at earnings and say, oh, they're making more money, they're doing well?
I don't think that's a function of their size necessarily. I mean, they don't really mention a ton of litigation, would surprise me, but I don't really think that's a function of how big they are. I don't really know better.
So you're saying the litigation did or did not surprise you?
It being not mentioned in sell side surprised me.
Even though you think it's a material thing?
Yeah.
Thank you. Questions? So, Bill.
Well, what happened in 07 to 09 in this company? What did the receivables must have been either pushed out or written off?
Yeah, so I can't really give good estimates on that because they were part of Aaron's, they just got spun off a few years ago from that. And Progressive Leasing is sort of like the point of sale business line of Aaron's that was spun out. So this is kind of a new business, sort of. There's not data that far back.
Jake.
Can you just talk a little bit about that premium you added for the 500 bips and kind of is that in line with the street? And I was curious if it's kind of driving your downside as like a plugin.
Yeah, so I couldn't find what the WACs were in the street. The reason there's 500 bips there is because I think there's a material risk long-term of federal regulation. Like I talk about in my write-up that there's a bill that's, that was introduced that could be passed. So I think because 5% of bills are enacted into legislation on average, I think putting that as a premium is like a fair way to assess the risk of this going through and that having a material effect on the operations of it. So short answer, I don't know what the WAC is in sell side, but that's the reason for the premium.
Dr. Paul.
AI loved your pitch the most, which apparently from my own perspective. Okay. So its questions are such. I think this will go for the mentees to start. What are the state and federal regulations, overview, I think the high level, for predatory lending that PRG has to adhere to, and how might these regulations affect their operating model? That's question one.
Yeah, I'll fill in. Yeah, so a bunch of states are releasing like new laws that limit the amount of interest charges that PRG is able to charge their clients. I mean, I think that's massive revenue. Ultimately. You want to get that?
Yeah, well, I think there's also 16 states that do not limit regulations.
Yeah. But
I mean, that is the regulation. If there was that bill 2349 would be passed, which is a federal bill, that would be set at 36%, which would completely alter the business model.
Yeah. So maybe good job, but if you want to go ahead.
No, that was good.
Nice job, guys. All right, next one. What free cash flow reduction should be expected due to the changes in depreciation and lending strategies?
Okay. Okay, yeah, this was kind of convoluted, I guess, but so basically, if rates do get under 36%, then I think they're gonna have to extend their lease terms at some point because they can't afford to be offering 12-month lease terms with like a 90-day buyout option. So if they are charging like 30%, they'll probably have to do a lease of like 3 to 5 years, and if that's the case, depreciation on that's like could be like 20 to 35%. So the implications on free cash flow, like right now, I think it's sort of illusory because you're having an add back of depreciation that's more than 100% of the inventory that's on your balance sheet. So you're depreciating more than what's on your balance sheet. And that's adding like in this year, like $500 million of free cash flow, which is like nearly all of it. So I think in the future, if this happens, you're looking at the DNA add back is going to be negative when it's netted with the CapEx of inventory. So I think there's going to be a material negative free cash flow in the event that interest rates go up.
And the last one's a doozy. It went crazy.
That went nuts.
I don't know why it picked on yours. Wouldn't it be impossible to ascertain from the survey whether respondents would not have considered leasing solutions for furniture, home appliance, electronics, even if they had options to get a loan? And further, to what extent their unwillingness to do so would not have posed a greater threat to BRG's ability to operate as a going concern than what the consensus is anticipating.
Okay, so to hit on the second one, yeah, it's.
You don't need to answer that.
Yeah, you know, I was like, holy cow. Yeah. But to get to the point, right, we can break this into pieces. It got way too I don't know why. I didn't change the setting, but I love yours. I think to summarize the second question, you're heading there, right? Wouldn't it kind of be impossible to just, from the survey, do what you did, for lack of a better term? Aren't some of these factors likely to kind of convolute? Although we applaud you getting a survey done.
That was awesome.
Yeah, it was awesome. What concerns do you have about the validity of your survey in an environment where that federal bill passes? How's that?
Yeah, that makes sense. I was gonna say, the materiality of my survey is a lot less than like the threat of litigation. Like, I think litigation, everything is the reason why it's going concern. But you're saying if there isn't that, then what's the impact of less?
It must have 5 negatives. We'll leave it at that.
Yeah.
That was no, that was well done.
Yeah, well done. Great.
Sorry, what percent of their like business is above or their APRs are above the 36%?
So they don't disclose what the average rate is, but if you go to their site and before you even apply, you can just get an estimate to like what you get quoted on based on like, I want to buy a fridge that's like $2,200 or something. That's in my write-up. It's like over 100% on like everything in every state. So I don't know. I have to assume.
Like what do you mean over 100?
Like if you buy a fridge for $2,000 in 12 months, you're gonna pay $4,000 for that fridge. Yeah.
How does that? What?
Yeah.
That's why you don't go to buy to own or lease to own.
Has management like addressed like anything about this litigation and like what they would do maybe if like they did work? Or just like would they ever stop?
Well, the litigation came out. Actually, give a lot of credit to these guys because they found it.
How did it get?
But yeah, that came out like August 25th. It wasn't in the earnings call. There was like an 8K about it, but they didn't mention it in like the last report. And I think it's worth mentioning like their chief legal officer like quit like 2 weeks after, and he was like just hired in May for personal reasons. So yeah, that's all I can add on that.
Maybe take one more question. There. Okay.
So, with all these regulations that have been going on interstate, what has happened to their market share when they introduce these 36% APR rates? And then, if they are still in that state in their market share, what have they done to combat the lower rates?
Yeah. Good question. Yeah. So market share has been pretty consistent. I had this in my model, but I should have included it. It has been pretty consistent because the space really is just progressive leasing, and online buying has been growing a little bit. So even though there is declining people purchasing this, because it's online, it kind of keeps the market share consistent. And the only players are really progressive leasing, Aaron's, which spun them off, and Rent-A-Center. So yeah, from market share perspective, that's been the same thing. And to combat that, there's really nothing that they can do. This is their business model, is to charge like 100% or like just extremely high rates. So yeah, it's like stopping that.
So who's next? So while the next team comes up, I just want to kind of call out the fact that we had August did a survey. How many people responded? 400. Anwar called the CEO and the CIO of a company. Who else did a survey? Someone else did something. They called. I did. Said I. Basil. So well, I mean, it's come up today.
Alex.
Yeah. So Alex was able to get a hold of a reporter who specialized in online gaming. So for the juniors in the room, and we'll hear more in a minute. The juniors in the room, this is really, really valuable. This is what we're really looking for, is to kind of differentiate your product. Zach.
Thank you. Yeah, so if you don't know me, I'm Zach Turbett. I'm currently a senior in the AIM program, joined by...
My name is Nick Moiser, and I'm a junior in the AIM program. And I'm Billy Rojak, I'm a junior in the AIM program.
Yeah, and I'm pitching a defense company out of Germany called Rheinmetall AG with a price target of 243 euros and 23 cents, representing an upside of 24%. Kind of my main idea around, picking this company and this sector is I really wanted a company that was in the event of, kind of a recession and economic downturn, that would be a little bit more on the defensive side and still be able to bring at least some type of cash flow coming in. And, stumbled upon the defense sector, having them, gain a lot of government contracts, already having a lot of catalysts, being the war and, NATO increasing their defense spending. And I came across Rheinmetall. It looked like there were some really solid opportunities there. One thing I wanted to kind of talk about earlier, or before we start Q&A, and Dr. Johnson, I kind of mentioned this to you earlier. Within the last 24 hours or so, Rheinmetall announced that they got a massive order from the German army, providing a lot of ammunition for their Puma infantry fighting vehicles. It's worth around 576 million euros. So before the news, I was around 15 cents above consensus in 2022. Now it looks like I'm just around consensus or just below consensus by 3 cents.
Have you added now in that assumption, or you already have it in there?
No, I don't.
Okay, so you are going, if you were ongoing doing research, you would be raising your numbers as well, so you'd still be above consensus. If you have something in your model where you're more optimistic than consensus, and this just takes everybody up by 15 cents.
Yeah, that's what I was going to conclude with. Yeah, I mean, obviously, it's only a good thing. So.
I think I just completely misheard you somehow. I thought I heard you say before the news I was 15 cents above consensus, and now I'm at. I think I misheard you completely.
Yeah, so consensus raised their estimates, so I didn't update my model because somebody had to look into it.
Right, but to Dr. Valentine's point, you didn't. So these numbers you're giving us are apples and oranges. They've all adjusted, and you're comparing their adjustments to you. So you're saying they've all come up. Basically, in a nice way, you just said the entire street has figured out what they've come to your number.
Well, I'm not sure exactly when this ammunition thing was going to come through. There's 2 other contracts.
Yeah, but the street is now at your number, whereas before they were below your number.
Correct.
But Zach's taking his number up 15 cents.
Yeah, you're also going to move up probably 10 or 15 cents.
Yeah,
that's fine. That's part of it. Yeah. Thanks.
Okay. Yeah. I assumed you were going to ask me about it at some point. So yeah, we can start with Q&A, I guess.
Questions, Tyler? Oh, you had a question. Question over here, Anwar.
I mean, I just have a question on like how these contracts work. Like you mentioned, like this is like an 18 to 21 billion dollar contract, and your base case has like a 3 billion, and your bull case has 4 billion. Like, how does it work? If you win a contract, how is it paid out across? Like, how many years is it paid out across? And like, can you win a partial contract, or how does the value of it?
I think your question was, if I'm if it's an $18 billion contract, why aren't you factoring $18 billion?
Yeah, kind of, yeah.
Yeah, I think a couple of reasons there. Because obviously there's no winner announced, I think it's somewhat unreasonable to assume that they're going to win the entire 18 billion of the contract, just because it can be shared between both companies that are obviously in competition. Originally, at least for the Australian contract, it started out with 300 vehicles. It got raised to 450 vehicles, or maybe a little bit more. So it's a contract that's going to roughly take 8 years. I'm confident that they will at least win a share of the contract. So I said, why don't we have them winning 100 vehicles, and then I just kind of, in my sense, I've sort of tried to quantify it, saying like if I have this average cost of one vehicle being, I don't know, 6 million, 50 million, whatever it may be, then just having that multiplied to get the base case and bull cases scenarios there.
Okay.
That makes sense?
Yeah.
Okay.
Are defense stocks defensive?
Are defense stocks defensive?
I
think they're safer.
The word's being used for 2 different reasons, right?
Yeah.
One's defending your country, right, from a war. The other one is buying a stock that will do well and slow down the economy.
Yeah. I'm not sure what you're asking.
Well, I mean, just do you see that a defense stock does well, outperforms when the economy gets weak, and therefore is a good place to be?
I think now it does, with current catalysts. I mean, especially for Rheinmetall, I think there's, in the next 4 years, there's a lot of like revenue catalysts. We have the Australian contract that I'm forecasting that they're going to win. In last month, they acquired a Spanish ammunition company for $1.2 billion. In fiscal 21, they had $400 million in revenue. We have, the war in NATO, increasing their budgets and defense spending. And then, of course, we have, this new contract that I still have yet to kind of implement into my model. So
that's good work. I was trying to more say, did you go and look at defense stocks to see if they tend to do well in weaker economic times like people are forecasting right now?
Not necessarily. I mean, looking at the G10 chart and, their historical prices, it kind of seems like a gradual slope continuously. So it's not something I necessarily dug into very much.
Other questions?
I'm going to correlate. I'm going to move out of my avatar for just 1 second because I have always wondered this, but it also gives me a chance to introduce comic relief, which I appreciate. Does this company traditionally make things that defend things or things that attack things? And what I want to know is you would say they make things. No, that's an actual setup. That's the setup question, but it's a serious question.
I want to say both. I mean, they have 5 different market segments.
Because to my friend's question, what I've always wondered is, are offensive stocks offensive? And what I mean by that, that's the comic part. I know I had to spell it out, which makes it not. I've always wondered if defensive stocks are defensive, but the companies that defend things. In other words, is there any difference between one who makes things that primarily shield or protect versus those that attack? In how those environments affect things. Given that you probably didn't know if defensive stocks are defensive, I doubt you investigated that phenomenon, but that is a question I've always had.
I guess I'd kind of come back and say, but couldn't a lot of military equipment be used for either defense or offense?
Yeah, but you look at like the Patriot missile shield, right? You'd argue that's a defensive product. If you look at someone who makes bombs, you'd argue that could be used both, but primarily offensive. So you have categories of companies.
Yeah, okay, good. Missiles and bombs, clearly. I'm just thinking like tanks and some of these things these guys are doing.
No, totally, I get it, but I always wondered if there's a delineation. I've never known.
Yeah,
okay. Anyway,
because you think the bad guys would be the ones buying the bombs.
Yeah.
And the good guys are buying more.
But I don't know if one is favored in a recession. Like if what type of spending by the defense, by a sector. Yeah.
I think Grace, and then Kendra, and then Harvey.
Alex was before me.
What's that?
Alex was before
Well,
me.
he's all out of my privilege, so.
Yeah.
I'll come back up, but Grace, next.
Yeah, nice work, Zach. I'm just a little confused, like how they're, like by the end of your 10-year DCF, they're like essentially doubling in sales. So I'm just confused, like how is that a stage 5 of the business cycle? And then also like what does the CapEx spend look like over the course of that? Like how are they basically supporting all of this growth?
Sure. So I guess.
And why is it not like high growth if it's doubling?
Yeah, I don't think most defense companies that are making like ammunition, infantry fighting vehicles would be considered a growth company, right? In terms of kind of like the CapEx spending.
No, but hold on, but to Grace's point, you're right. That's a good observation. But to Grace's point, you've modeled growth into your model. So,
like, are you forecasting a war?
Well, but to some extent,
how's there so much spending in defense?
Well, yeah, well, I think what I'm assuming of the war is the current war that we're currently in is going to take a while to finish, right? After kind of talking to a lot of my sources, I read a blog or article, I'm not sure which one it was, but by Harvard, kind of addressing like, Russia's strategy to kind of end the war. They've kind of moved, Ukraine's kind of pushed them back now just because like the winter, and they historically don't, do well into winter. So it's assumed that they're going to make another push back into the spring, which will obviously spark a lot of more, war. And then, in 2028, I have that Bradley contract that they're going to win, right? So that's that $45 billion contract. I think I'm having them win. See, my base case, I have $4 to $6 billion, having them win for my base case there.
Can I try to answer the question? Because I think I know your answer, and I think I can answer it. Is that you guys know the difference between cyclical and secular? So cyclical are things that kind of go up and down a lot, and kind of like the economy, and secular are things that take a real long time to happen. And I think it'd be fair to say that going all the way back to maybe Ronald Reagan to up until maybe 5, 7, 8 years ago, it seemed to be the world was getting more and more peaceful, and militaries were kind of backing down a little bit. And what it feels like, unfortunately, especially for your generation, is that we're shifting on a more secular basis. We're going into kind of this longer term now with the threats, obviously, Russia did. Australia is concerned about China doing something there. Taiwan's clearly concerned about China. Japan's worried about China. So all of a sudden you got these countries around the world starting to say, maybe we ought to rethink this whole world getting more peaceful. So if that's true, and that's I think what we talked about, then you do think this is more of a growth industry than it would have been over the last 20 or 30 years. Okay.
Correct. Yeah.
Okay, great. just because of time here, do we want to have your mentees give us a thought on what is the company's best moat, most defined moat?
Yeah, I think their most defined moat is their network effect. That's just because of how much networking it takes to secure these contracts and how important the contract is to the actual business. So I think that the Rheinmetall has set themselves up with a super strong network. They're trusted by NATO and the U.S. Department of Defense, so I definitely think that's their most valuable.
Great.
Yeah, I can kind of touch on revenue drivers, like their best drivers. So in the short term, we're expecting there's five different segments: vehicle systems, weapons, ammunition, electronic solutions, sensors and actuators, and materials of trade. Obviously, a lot of those things do a lot of different things with defense. But in the short term, weapons and ammunition, Zach just talked about the acquisition of Expal, EXPAL, I think I said that right, which in the short term, we have weapons and ammunition having the most growth just because of that acquisition. And then long term, obviously, with these contracts that we're expecting them to land, we have vehicle systems being their long term, their best driver, mainly because of these contracts that we're expecting to land. So,
yeah, great. Maybe one more question. I know I said there's a lot of people, but just for time's sake, I'm going to take one more question. Who's next? Do we take Alex or?
Oh yeah.
No, I was going to say Kendra. Are you next? Hey.
Anyway. Oh yeah.
No, are you
yeah.
next? Go.
Yeah. Okay. So, hey Zach, great job. I was just wondering, so I heard on Wednesday by CNBC that even the procurement budget portion of the DoD is increasing by like 28% or something. And they were talking to Raytheon, but their biggest issue is that their lead time is like 2 years. Have you done any look into what your guys' lead time is from the point in which you get the contracts to the end output of the finishing of it? And do you guys have like an edge on that, or have you done any research into lead times?
I think it depends on the type of contract, right? To answer your question specifically for the Australian contract, and I kind of talked about it a little bit in my write-up, is this contract I'm assuming they're going to win in Q1 of 2023 and expecting to start production at the end of 2022 or the beginning of 2024. And what I kind of talked about earlier is, or at least in the write-up, is that there are a lot of pieces and similarities between the Boxer, which is one of their different infantry vehicles, and the Lynx, which is the one that they're proposing. So they can actually tap into that existing supply chain, get it out much quicker. And I think that's something that Hanwha is not able to do. So.
Excellent, thank you.
Harvey.
Harvey.
Last ever pitch in the aim room. Don't show up. Oh, I never showed.
Hey everyone, my name's Harvey and this is my mentee Henry, and today we're pitching a buy recommendation on Davide Campari, the alcohol manufacturer, distributor and marketer.
Yeah, so my portion of the recommendation include Porter's 5 forces, economic modes, revenue drivers, and the business life cycle as well.
So I'll talk a little bit about my screening process. I wanted to find a defensive stock with a long history of performing strongly during economic downturns. So I turned to the alcohol industry. I also wanted to find a company that has room for growth. I spoke with Dr. V and he recommended I look for a product that could potentially be the next big thing in the alcohol industry. So I thought back to my travels this year across Europe and Australia, and I recalled loads of people drinking alcohol spritz, which I've never really seen before. I delved into Aperol, came across Davide Campari, who owned this brand, and 50 others, and then my research went from that.
Great. Can you, for those who don't know what alcohol spritz is, what is
Aperol
it?
spritz.
Aperol. What is an F? Does everybody know what Aperol spritz are? Some of you do, but
sorry.
But for those of us who don't, kind of distill it down to the primary things that make it up.
Aperol and like lemonade and stuff.
So what's Aperol?
Aperol is its own spirit. It's called an aperitif. It comes under an umbrella of aperitif. It's like a liqueur, yeah.
Okay.
But the good thing is, think about it this way: like, say you want a vodka martini, you can put whatever vodka you want in, But if you want an Aperol spritz, you have to put Aperol in it.
It's like a Tangerine tonic.
Yeah.
Okay. Got it. I'll do that for the bread. So good. Okay. So questions.
Can I say one common question?
Yeah, sure.
One common question was about insider holdings. I do have large insider holdings at like 56, 57%. This large holding is by the Garavoglia family, an Italian billionaire family who've owned David Campari for many generations. The chairman has been in place since 1994. Before him, it was his father, and before him, it was his father. So it's been in the family a long time. This family know the industry inside out. They know the company inside out. So to have them at the wheel of the company is actually a benefit and a strength rather than a negative.
Good. Questions?
Why is Aperol Surf so cyclical in Google Trends?
Yeah, so
Sorry, can you say a little
It's a
louder?
summer drink.
What'd you say?
I was curious why it was so cyclical in Google Trends.
Yeah.
Why so cyclical? And Grace answered the question by saying it's a summer drink. Sorry, go ahead.
Great. To be honest, you kind of hit it now on the head to some extent. It's cyclical. It peaks every July. Midsummer it is a summer drink. That's when people are consuming it outside the most. They're snapping it. They're putting it on Instagram. They're tagging it. That's when analytics spikes. Google searches spikes. But in terms of consumption, you know, it's starting to pick up now. You have on-premise drinking, which is in bars, clubs, pubs, and then you have at-home consumption, which is obviously drinking at home. And this is actually starting to spike now because it's become a consumer favorite. The demand is sticking, and people now want to consume it at home instead of just on premise.
Is it showing up on college campuses?
Yes,
No.
it is.
Wow.
Really?
Really?
Yeah.
Really?
Look at
counts.
that. I wouldn't think of a LaPointe, but okay.
I'm joking.
Other questions?
I was literally like,
Anwar.
What does your revenue growth look like after like 2024? I saw like it dropped quite a bit from like 31% expected to like 10. So I'm curious what it looks like beyond 2024, and then like what percent of your revenue comes from like the US, and I'm curious like which countries did you notice that this was like more popular?
Sure. So after 2025, I have revenue holding at around 8%. This is almost in line with consensus belief, maybe a couple percent higher. Your next question was the geo rev, did you say?
Yeah, like what percentage?
Yeah, I can help with that. So just in general, the revenue drivers are split up by super region. But to answer your question, America accounts for the Americas, so they account for 42.7% of total revenue.
How much?
42.7%. Okay. But the US accounts for like 26%. It is their largest consumer.
When they say the Americas, is it Canada and Mexico, or is it like South America?
North America, South America, and Canada.
All right.
I think people in South America might be disappointed if they didn't think South America was part of America, but yeah. So, I guess maybe they don't go to that market, right? But they are, that would be part of America, yeah.
And what was the last question, Anwar?
I think you answered them, so I think
Yeah.
you're good.
Grace.
Like, are they acquiring these companies, or are they like putting out new products? That
Yeah.
might just be like a simple
It's a
question.
combination of the two. Since 1995, they've acquired 25 brands, around 2.5 billion of value added to the company, and they focus on a strategy of organic growth and then acquisitions as well.
So what's like the percentage of like organic growth and then like
Organic growth this year, it changes every year, depending on what they acquire and if they don't acquire. Like this year, they acquired Dana White's whiskey company, Howlerhead. I don't know if some of you know that, and another distillery. But then last year, they acquired like 6 businesses, so it changes year to year.
okay, and then like of the big names that you kind of mentioned in your write-up, were these acquisitions or were
Aperol? No,
Yeah.
they acquired Aperol in 2003.
Okay, thank you.
So, real quick, I'm sorry, just a second. Don't make me forget though. So, this is going to be for Henry. So, how did you use either FactSet or Refinitiv to help improve your analysis?
That's a great question. I think in general, FactSet did a great job laying out how Campari splits up their revenue. At first, I would assume that they would split it up by brand, but I then realized that they did it by super region, which made it easier to integrate all those brands because they distribute those brands globally. So, given that FactSet has a great user interface for segment analytics, that definitely helped me a lot. So.
Good. And so for all the, especially for the juniors, senior might be interested. For the juniors, so you guys might remember we asked, are there any students interested in becoming certified, either FactSet or Refinitiv? And we have Henry is one. Is Rich here? I think I saw Rich. Oh, he was here. I know he was here. He's still here. Rich, stand up if you're here. Okay, left. Grant, are you here? Okay, and Stephen, I think, is ill, so he's not here. But Henry came back and said after he had one of them done, he wanted the other one done. So he's actually certified in both Refinitiv and FactSet. So I bring that up. Yeah, for two reasons. Number one, any one of you, especially like the juniors, you might want to think about doing this. It's not that difficult. Talk to Henry. And it can improve your stock range. Other questions? Oh, sorry, Alex.
Yeah, great job, Harvey. It seems like you utilized a lot of like outside resources here. I was curious if you could touch on the industry experts and then the editor of Punch, kind of what how that factored into your stock call and your forecast.
Sure. So I looked on Google to find some of the biggest trade magazines related to alcohol. Found Punch magazine, and I found they did a piece on Aperol and its rise as like a prominent drink in today's society. And I basically just wanted to find out their opinion. Consensus is far more bearish in their Q4 and fiscal year 23 sales growth, especially for Aperol. And I spoke to these experts, and they basically just came to the assumption that they believe that now Aperol has reached a point where it's a consumer favorite and it's going to grow regardless of whether it's the summer months, whether it's the winter months. Yeah.
And can I just follow up on this? So how much did you have to pay these people to talk to you?
I didn't pay. No, I just said I was.
You didn't have to pay. Isn't that amazing? So you guys can go out and get information. I know it's not easy.
They do ignore you though.
What's that?
A lot of them do ignore you.
Oh yeah, a lot of them ignore you. They're welcome to this world, right?
Yeah.
That's because we're not paying. It was called influencing without authority. And so how can you ultimately influence someone to return your call or your email? Was there anything that you did in particular you think that kind of warmed them up to be receptive to your request?
Just play on the fact that you're a student at university and how much you like their work. Even though you've never seen it before, just say that.
I am just curious, so do you think the ADR trades enough for us to buy let's say a 1% position in our portfolio?
Yeah, I do believe it does. The 65 or 30-day average is around 64,000 shares at $10 a share. So 1%, we can buy like $6,500.
Did you look at this daily? So taking a daily average could be interesting. Could be a helpful start. Did you take a look at what it actually trades over, let's say, like an Excel, just down, let's say, the last 30 days, how much does it trade?
I did not do that. I just looked at the average over 30 and 65 days.
Yeah, so this is more about, and I'm not trying to put this spot, Harvey. I'm trying to make sure that everyone else understands, the juniors especially. So with ADR, you got to be careful because in this case, this stock had one day where it traded 400,000 shares, and then a whole bunch of days where it traded nothing. And if we decide to go to the treasurer of Marquette and say we want to buy this, and they put the order in, and nothing's there to trade, we could wind up paying some big premium in order to be able to buy the shares. So we just gotta. I know it's tough, and it's kind of not your fault, the fact that we do have to work in these ADRs. Dr. Wall and I longer term want to be able to trade in foreign currencies because I was doing it 15 years ago with a E-Trade account. It's not expensive. It's not hard to do. So it's like 8 countries you could buy and sell stock in directly instead of ADRs. But for the time being, we have to go to this world of ADRs. So just make sure for the juniors looking at ADRs that you look at what's actually trading over a number of like the last 30 trading days. Dr. Wall.
It asks pretty basic questions, and you've covered a lot. So I'm going to go off the script here and that's building a question I've received. Can you walk me through the construction of your WACC? Kind of what's your equity risk premium, what's your after-tax cost of debt, and why you feel confident in the WACC?
My equity risk premium is 5.5%, like we agreed in the class.
And then what's that cost of equity then result?
Cost of equity is 7.19%. 6, yeah. And my after-tax cost of debt is 1.09%. And I compared my WACC to like a bunch of sell-side reports, and they're all between like 6.2, 6.6%.
Right, but what cost of debt did you use to get to your WACC?
1.09%.
What's wrong with that?
Not sure.
It's below the risk-free rate, right?
Yeah, so it's below the risk-free rate, and once again, we're still trying to kind of, I guess, introduce new things here, but we really should be using more the market rate or what they're going to have to borrow in the future periods. And so if you know that right now that people can go out and get, the government will pay them 3.5 to 4.5% interest, then it's kind of hard to assume a company's going to be able to go out and get someone to lend them money at, well, that's after tax and regives, right?
Yeah.
So pre-tax, 2.5%. So you want
That
to be
makes
thinking of,
sense. But I was just looking at like the historical what they did.
Yeah, yeah, and so that's something we try to be real careful of, especially in this high interest rate environment. We've been tripped up a couple times this semester, and so I'm going to keep trying to point it out gently as a teaching moment. Mathematically, to Dr. Valentine's point, that can't happen. Otherwise, this company would, the most intelligent decision would just be shut down, borrow an infinite amount of money, lend it to the US government, and then just sit back and collect checks for the next 30 years.
Sure.
Yeah.
So how can you like forecast the future?
Well, if nothing else, you need to, you talk to any of us, but at a starting point, start with the risk-free rate that we're using in assumption, and then add something to it, right? So a lot of very low-risk companies currently, I'm guiding students towards 4, 4.25 as a starting point, because we're using something like 3, 3.5, right? And so it just makes it easy if you start at a common basis. But the more intelligent way to do it, and it can't always work, is if they borrowed money in the last few months, and you look at definitive, I think you find that rate, that net effect rate, even if it's got converts or something in it, is going to be in that range once you do the real math of what occurred. So then you can actually use real rates that you're using right now.
Sure.
the one thing that I've done, but as you guys know, I'm more of a fan of kind of multiples, but is to look at the yield of maturity on some of the longer term debt. Do you get a feel for where it is?
But the WACC was still a little bit lower, a little bit higher than what some sell side analysts actually said.
You know my big thing on that. Analysts make this mistake too, which I find infuriating.
Yeah.
But yep.
Other questions? Okay. Well done. Before I forget, we have one more person going, right?
No.
Okay. So before I forget, real quick, because we're gonna take photos. So, but for those of you who are